This is a special report. Thanks for joining us at XM.com. Fitch unexpectedly downgraded the U.S. government's debt credit last week. What could that mean for the markets and, of course, the U.S. dollar? I'm Christina Marujos. With me today is our senior investment analyst, Marios Hadjikyriacos. Marios, the latest data suggests the U.S. economy is in pretty good shape, and this downgrade just comes a few months after the debt ceiling negotiations in Congress. Therefore, how did this downgrade come about?
Hello, Christina. Look, honestly, I don't think this was a huge surprise for anyone that is really monitoring the situation in the United States. So what happened? One of the biggest credit rating agencies, Fitch, downgraded the quality of US government debt from the top tier of AAA down one notch to AA+. And their rationale behind this decision was US government spending is almost out of control. We've got huge deficits and the debt load is increasing, and there's no credible plan from either political party to bring spending back under control. Now, Fitch also discussed demographics a little bit, and they basically argued that you already have out of control deficits, and you also have an aging population. So over the years, you are going to have to increase spending on programs like Social Security, Medicare, things that will naturally require a higher cost as the population increases. So they are looking at the overall situation and basically arguing that we are on an unsustainable debt trajectory, and it's most likely going to get worse over the years because of population growth, essentially.
I see. And finally, let's turn to the market reaction, Marios, because following the downgrade, stocks took a hit, the US dollar gained, but what lies ahead for investors?
Yeah, look, here's how I would characterize it. We saw a pretty big market reaction last week. A lot of people think that was because of the downgrade, but in reality, in my view at least, the downgrade was a minor event. The big event was an announcement by the US Treasury on the same day as the downgrade that said, Janet Yellen, the Treasury Secretary, basically said that they will be increasing how many bonds they sell to the markets over the coming months. So how much debt is auctioned to the markets, that number is going to go up over the coming months. And they'll also be issuing longer term debt, so 5 year, 7 year, or 10-year bonds, something that they weren't really doing in recent months. Now, what does that mean? That means when you issue a lot of bonds and there's a lot of supply of bonds hitting the markets, that puts upward pressure on yields, right? Investors demand a higher return to buy those bonds. Now, what do higher bond yields mean? Well, in isolation, they are usually positive for the currency, so a positive development for the US dollar, and negative for riskier assets like stocks, for example. Now, I think we're entering a situation where we are going to see yields. We're going to see a lot of upward pressure on yields. The first argument is what the Treasury is doing with a lot of increased debt issuance, and the second leg is the US economy is doing well. The markets, I think, still haven't properly priced in a scenario of higher for longer interest rates. That might change if we get a reacceleration in inflation this week when we receive the latest data. So I think you have two separate forces pushing upwards on yields. And I'm really monitoring the situation in the bond market. If we see a new higher high for this cycle in long-term yields, that I think is going to have big effects on other markets. Specifically, it would likely be positive for the dollar, and it would likely be negative for stocks. So we could see, the dollar coming back to life, and perhaps the rally in stocks that we've seen this year losing some of its steam.
Marios, thanks so much. This was a special report here at XM.com.